Today's lesson, we're going to focus our attention on what we call immediate annuities. You recall in a previous lesson we talked about deferred annuities. Here we're basically saying we're now at the end of the accumulation period, and we're now going to take this single deposit, a single lump sum of money, whatever that may be. Let's say you got $500,000 now accumulated over the years. You now want to take that $500,000 and convert that now into some kind of an income. So we call that an immediate annuity. Why it's called immediate is because it usually starts, in fact it will start, within what we call an annuity period. So for example, if your annuity period is an annual payment, in other words, you want the income to start every single year, then every year you get a lot, you're going to get a check basically, then the income will start within that particular year. If your annuity period is once a month, so in other words, every single month you're actually going to get an income, then you deposit the money today, for example, 30 days from now you're going to get that particular payment, and then every 30 days from then on for the duration of the annuity period, you're going to get that particular income. So therefore, it really started off really with a lump sum, a single deposit, and that single deposit then gives you some kind of an income. So we're not deferring anything. We're basically paying it out either monthly, semi-annually, annually, no longer than a year, every year from then on. Now, what's very, very important here is that when we're talking about immediate annuities, okay, is that there are two kinds of immediate annuity types of payments. And it's very important that you know the difference between these two. First of all, let me emphasize that in all cases here, we're always talking about non-registered money. We're not talking about registered money. We will be talking about those in a subsequent seminar. But at this point, we are talking about non-registered money. So in an immediate annuity, there are what's called non-prescribed and prescribed annuities. And you say, well, what's the difference between one and the other? In both cases, for example, in our example, we said that we've got a single sum of money of $500,000. And what happens now is on a non-prescribed basis, of course, so here's my $500,000, give me an income. So what happens now, if you remember that annuities are a combination of interest and principal being given to you. So you have what's called a blended rate, you might say. So if, for example, I've agreed to you that I'm going to give you $5,000, let's say, for every single month, it's a blended rate of interest and principal, essentially. So what happens now, of course, is that as you accumulate, as you start getting payments on a monthly basis from the insurance company, of course, the amount of your money will be depleting over a period of time. So really what's happening here is that there's a sort of a sense of depletion of your cash. This component here is what we call that interest payment. So on an unprescribed, in the early years, what you got is very, very high interest payment, very little principal. So as a result, what happens, if you remember, that you have to pay tax on that interest, and it's taxed right from the first dollar. So if you have a 50% tax bracket, for example, then 50% of whatever that interest happens to be is going to be taxed. So it isn't a very, very good tax-favored product, because obviously, because you are in fact getting more interest than you are getting principal, then obviously you're going to have to pay a lot more tax. So therefore, from a tax-favored position, it's not a very good plan, this non-prescribed. So you may look at this really as almost like an amortization table. Any of you who have a mortgage will readily see that in the early years, what you're doing is you're paying an awful lot of interest towards your mortgage and very, very little chipping away at your principal. And at some point, of course, that switches over and it becomes more principal. So you can see that really what you've got here is really a mortgage payment. You might see a reverse mortgage. Now, because of the fact that a non-prescribed is not a very good tax-favored product, what the authorities have now allowed us to do is to actually issue you a prescribed annuity. In other words, you can buy the same annuity, same $5,000 and everything, no difference, okay? However, it's prescribed, and you say, well, what's the difference now between that non-prescribed and prescribed? Well, basically, on a prescribed basis, what happens is this particular line is actually straight. So in other words, this is really prescribed. So what happens now is that much of that income here is actually principal. Okay, it's actually principal here, and this becomes your interest payments in here. So that interest payment is going to be lower, so therefore less tax. So the moral of the story basically is that the difference between these two, and what you have to remember, is that a non-prescribed is not tax favored. A prescribed annuity is tax favored because, in fact, you're going to be paying less tax on a yearly basis. So therefore, gives you higher cash flow. So that's the essence of it, is that a prescribed plan gives you better cash flow because it is more tax favored.